Hi, welcome to Numeric's video blog, your expert source for derivative trends and topics. I'm your host, Jim Jockel. Joining us today is resident trading strategist and FX expert for Numerics, Udi Sella. Udi, how are you?
Thank you, Jim. Oh, well.
Well, thank you for joining us as always. As discussed in a recent story published in Treasury Today titled FX Forwards, the Wrong Option for EM Currencies. Though the FX forward is the most widely used derivative instrument among corporate hedgers, some experts are now questioning the effectiveness of utilizing forwards when it comes to hedging emerging market currencies. So, Udi, as debated in the article, is this more of a case for the instrument being deployed at the wrong time, or is there a broader discussion about the global economic cycle to be had?
It's a few things actually, Jim. The first thing is timing indeed. If you take an example of Russia, and let's say you had receivables in Russian rubles that you had to convert into dollars, had you converted them in mid-January, you probably would have locked the highest rate ever and have locked a loss. That's one part. The second part is really about using forwards as opposed to, one, not hedging at all, being exposed all the way up, or using derivatives such as options where you can lock the worst case scenario and benefit from any favorable market move.
So in the past, we've talked about double no-touch options. We've talked about, different option type strategies, right? So if forwards are not the right strategy at this point in time, what other option strategies should be considered?
So typically, the most basic hedging, and let's say we're talking about FX hedging or commodities hedging, is really using some kind of an option. Could start with a vanilla option. Then you can add an element of knockout. So let's say if we stick to our Russian example, if the ruble is now trading at 57, and you need to hedge the purchase of US dollars, you can buy, let's say, an option which is struck at 60 or 62 rubles for $1, and then add a knockout on the downside. So let's say if ruble dollar exchange rate hits 50 rubles for $1, the option would cease to exist. So basically, these options are cheaper, and the knockout goes your way. So that's another example. And then if you want to hedge a cash flow, it would make sense to buy an average rate option, or what they call in other asset classes, Asian options. So basically, you hedge the average of fixings. And again, if it's a cash flow, ongoing cash flow, your hedging cost would be lower.
And so, obviously there's still a lot of unrest in the marketplace right now. I'm thinking specifically around Yemen. What other impacts can potentially we see as it relates to FX?
Well, we've seen recently a few economies, emerging economies, being hurt. One of the most interesting ones is Brazil, due to political unrest. So basically, the Brazilian real has weakened from levels of something like 230 reals to $1 to 330 since the elections of the re-election of the existing president, Dilma Rousseff, which the market didn't like and the Brazilian industry didn't like. In a similar fashion, we're seeing weakening of the Turkish lira, again, due to political unrest. And we see that now, given the different economic cycles and the growth in the US as opposed to most other economies, emerging markets are suffering because they see less FDI, less foreign direct investment, and the funds are being repatriated into the Western economies, namely the US, and that is taking the toll on those economies, and as a result of the outflows of dollars, the local currency, the respective local currencies weaken dramatically. Accelerated.
So, arguably we've been in a low rate, low vol environment for quite a bit at this point in time. But now the U.S. is looking to raise interest rates probably within the next 6 months. It looks like that's where the market consensus is. What's going to be the reverberation as it relates to the EM currencies?
So first of all, if you look at the Fed funds futures, you see that the hikes are not that dramatic. So I think it's more symbolic. So moving to, raising 25 basis points, 50 basis points. I think that even up to 2017, if the Fed funds futures are predicting adequately, we will see the U.S. rate at 1.5%, so that's not a dramatic interest rate differential. But in terms of funding and in terms of investing, I think that we would see more flows going into the U.S. equity markets, real economy, and that could really weaken those emerging economies further, and even create political unrest, which in return could impact Western economies such as even the U.S. economy.
Well, Udi, thank you so much for joining us and shedding light on this topic. And clearly, we look forward to continue discussing this with you again as events continue to unfold. On the Numerics video blog, it's our goal to examine the topics that you want to talk about. So keep the conversation going on LinkedIn and on Twitter at NX Analytics. And check back soon for the latest industry news, blogs, videos, research, and technical papers. Thank you.